Thank you, everyone, for joining this liquidity panel. We have a great panel today. We have a big one, 6 people here. And I just noticed that 50% of the people here are headquartered out of Switzerland. By chance, I guess. It wasn't on purpose, but I guess perhaps it has something to do with Brexit. But anyway, so I'm not going to introduce everyone. They're up there. So we're going to have to put some pace on this panel today. So I'm going to start with the first question, actually. I'm going to go straight to it. So the first question is, what can make a liquidity provider unique in this competitive space? And what is your particular role in this segment? I know we have different aspects here from technology and LP, banks. So if I start with you, Alex.
So at Nekstream, we help brokers find FX, and now this is deja vu because I just did the crypto panel, crypto liquidity. What can make them unique, you know, we noticed that a lot of brokers come to us, and it's a matter of casting a really wide net. So for example, and I'm seeing a lot of brokers, a lot of LPs are doing that. So for example, we had one, he wants single stock CFDs, Russian stocks, or a certain type of spread on gold. So you really, it's hard to find unique, but it's a matter of like just being able to accommodate those specific things, especially on FX, because on FX, everybody already has some sort of an LP, and it's a question of what clients they get. You know, it's the 80-20 rule. They get one client, like that's exactly what happened with one deal we did. You know, we got one client, he had one client who wanted to trade Russian single stock CFDs, and now he's looking for an LP. He gets that LP, and then you can carry over and capture some of that other business. So maybe my suggestion there is casting a wide net would be a big help.
Okay. Peter, from your perspective?
Having a franchise, I think, really helps. So if you're a Japanese bank in Tokyo, you obviously got natural business, and your forte is going to be quoting that sort of pricing for that currency pair in that time. For example, Russian banks who are connected to MOEX have a natural advantage in quoting Russian ruble. And it's being able to match uncorrelated flow with liquidity providers that got a natural interest in being able to competitively quote in those products.
Right.
Yeah. Also, I think being able to provide custom liquidity, because every trader has a different need. So it's the ability to provide custom liquidity, genuine liquidity, non-recyclable. Being able to make prices at any market volatility. This is also what makes quite unique. Accessing liquidity in the different data centers. You know, this is sometimes unique.
Ozgun, from a bank perspective, slightly different, I guess.
Yeah.
You guys look at liquidity provision differently. You probably say no one here is a liquidity provider.
Yes, it's just me, the outlier in the audience, in the panel, and I am really sorry about my voice. I didn't party last night. I'm genuinely not feeling well today. Okay. But from our perspective, obviously as a market maker, it's really quite tough to be unique in this competitive landscape. There's a new market participant coming in, you know, non-banks coming in, acting like banks. So it's really tough. We provide pricing to so many different types of clients. I believe our uniqueness is in how we manage those relationships, i.e. how we make sure that they're receiving the right liquidity for their needs and via the right execution channels. Ultimately, having a balanced two-way relationship with the clients makes our offering unique.
And of course, you guys are in a unique position where you have kind of bigger flows, and perhaps you can internalize more or less.
Of course, we provide customizable liquidity and technical solutions. We internalize the flow, thus, causing low market impact. And we're intelligent in the way that we're hedging client flow, and which are key instruments for clients when they choose us, when they make business with us. Yeah.
Okay. Cristian, from your perspective, technical side?
What we see from the client side is really what's important is to be able to cater to all your clients' needs. Everybody has unique needs, really. So if you're able to work together with the client and offer for them what they really want, I think that's the most important, really. Having a flexible system on your side that is able to customize on the pricing side and also on the trading side makes a lot of difference. Distribution is also very important nowadays. I think having the ability to push the liquidity via any venue and any platform of choice that the client is interested in, it's also something that makes a liquidity provider unique. That's where I think where we come in, really, in order to be able to help with this.
And when you add to that the prime brokerage aspect, where you have no last look liquidity, last look, big ticket feeds, aggregated streams, etc., etc., clients will have a wide range of flow that they're going to send to the market, and being able to match the right type of flow to the right type of feed is where the prime broker comes in. You know, you could have some clicking retail clients that would be well suited to relationship feeds like Ozgun, but you also have, say, news traders who have very aggressive flow, which you would send to ECNs where they're much better and much more likely to be accepted by resting bids and offers. So making sure that the right flow goes to the right place, to the right liquidity provider is much better than just relying on one LP that can hopefully cover everything you need.
Mohammed, you guys have made a lot of noise in this space as well, so let's hear your views.
Yeah, I think TradeTech Group represents a little bit of everyone on the panel. For us, it's about what the partner needs. And not necessarily just what they need now, but what they might need in the future. So we're a little bit of tech, we're a little bit of ECN, we're a little bit of aggregation, we're a unique price with our own market making organization. And every broker inside of the broker has a little bit different types of business as well. So it's really about working with the broker, figuring out all the different types of order flows that are coming, whether it's FX, single stock, metals, oil, index, and then trying to figure out what the right solution is, whether they want to click, whether it's a fixed integration, do they need a little bit of credit? You know, I think one of the big things that makes us unique is our balance sheet. You know, we're a stable counterparty. You know, people know that we're going to be there tomorrow. We're a FTSE 250 firm. And, you know, if you want a small ticket feed for retail order flow, great. If you want to move big size in the market, we have that as well. That's really, you know, kind of where we are. You know, listening to the broker, what are you trying to do? What's the end customer experience you want to provide? And then we'll make that happen. That's our uniqueness.
Cristian?
I also wanted to add that I think location is also very important, really, in providing liquidity. Now, you need to have a presence in all financial centers, really, if you want to cater for all your client base. And I think that's really important if you're able to do that.
Yeah, but that also fragments the liquidity, right? So that could be a bad thing if you have too many locations.
Definitely, of course. It depends on everybody's size, but if you're able to achieve that and really help offer to your clients local liquidity, I think that goes a long way.
I think that's actually something that not a lot of the brokerage community understand, is that liquidity is fragmented from the start, right? Because, I mean, no one's originating a DAC price in New York. No one's originating an S&P price in Tokyo, but yet you're consuming liquidity everywhere. So really, the firm that you're interacting with, where is their unique price coming from, right? Because if you're consuming S&P liquidity in London, then you're 80 milliseconds away from origination, right? Regardless of how close you are to them. Cross connect, great, but your price discovery is still 80 milliseconds away. So, I mean, liquidity is fragmented in general. It's how your LP can mitigate that and again deliver the best experience to their customer, right? Not so much your customer as an LP, but the end consumer, right? And I think that's where, you know, you kind of get separation amongst the LPs, is how well do they do that? Because at the end of the day, a broker that's marketing to a retail client, they just want to make their retail client happy, right? And the LP just really wants to be a part of the equation. And everyone needs to make a little bit in the process.
Alex?
I totally want to agree with both of you guys because what we do is we do, consulting. So we bring clients to guys like Alpha, for example, or, LMAX, CFH, Divisa, of course. And what happens, the server location, I mean, that instantly knocks people out. So if a client has a New York server, so a broker has a New York server, and the LP has only a London server, that's done, for that LP. Like I couldn't bring, for example, like LMAX has London. I couldn't bring a client to LMAX with the New York. They have a New York, but it's not as big as the London. I couldn't do that. And we built in fact, we built this tool called LQ Edge where clients put in their liquidity requirements, and based on those parameters, it spits out the LPs that are a match. And that's like one of the first parameters is server location. So I completely agree with you guys.
At Saxo, we have 3 hubs, London, New York, and Tokyo. And in those 3 hubs, we only have local LPs who price locally to keep the response times down, the fill rates up, etc. And also, all the LPs have to internalize to reduce the market impact. So being able to optimize the client's experience by having the right LPs in the right places and matching the flow to the particular LP is a big advantage.
Okay. So I just wanted to move on to another subject, which is the high-frequency traders and aggressive traders. We at Divisa, we have a clear strategy on how to service them. We know we have a plan. We think we should be able to handle aggressive traders. So I wanted to start with you, Alex. I mean, you used to be a high-frequency and very aggressive
Still am
trader.
a little bit, yeah.
Yeah.
A little bit less.
So how do we handle people like you?
Blend me in. If any of you guys can do it, I'll open up an account. So I need to be blended in with the retail flow. So if you're getting retail flow,
that's the easy way out.
That's the easy way out. Yeah, you gotta blend. I mean, a lot of brokers now started separating the retail and kind of like, so retail is like clickers and meta is, meta EAs and stuff, that's retail. And then you go like fixed API, like which is some of the trading that I did and still do a little bit. They put it in a different pool and it instantly makes it a little bit tougher. I mean, there's still ways to get around it. I mean, no last look helps. Tagging, how you handle tagging helps. So it's a question of your LPs, but quick and easy answer is just blend me in with the retail, send your LPs a whole bunch of retail and let them not tag my flow and not last look me, and I'm happy.
Dream scenario.
It really is. If anyone could do it, come see me after the show.
Ozgun, how do you guys handle that?
That's when we would widen a client, by the way. Okay? Just,
you would just widen?
Just widen.
Just widen.
For a couple days.
Unless we're getting the client tags where we can separate you from the flow. Sorry, I had to say that.
So when you know it's Alex,
then you're just permanently widened.
Look, from our perspective, from a market maker's perspective, it's very, very simple. Clear rules of engagement with the client, okay? We understanding both the client needs and the liquidity provider's needs and agreeing to the trading parameters beforehand and constant two-way feedback on flow. That's it.
Otherwise, all of the clients, along with Alex, are going to suffer from his flow rather than getting the flow that they deserve from the alpha that's included in their business.
Ryan?
Well, I'd just like to state that, it's because of people like you that and I'm going to say something positive, that the system has become more efficient, So I try to, take on this kind of business just to test our systems, improve it. From when I started at SwissQuote to where we are now, we've improved greatly just because of company algo traders, high frequency traders, things like this. So, I welcome this business, this kind of business, in the sense that it helps us continually improve our system. We know you help us identify all of our loopholes and areas where we need to improve. So, I think it's good to have these kind of participants in the space.
Totally right.
I think so too. I think high frequency, though, commonly everyone gets grouped in together, high frequency. I really think that, like, if your model is high frequency and that it's got a lot of turnover, but you actually have a genuine view on market direction, then you're going to be fine. If you're running some type of crazy multi-venue ARB model, then you're going to end up homeless quickly, because that's just not the way the market works.
It goes back to the correlation, doesn't it?
Yeah, I mean, a lot of high-frequency guys effectively are looking for LPs that have created a artificial market, a market that doesn't exist, right? And pretty soon you find it, right? And you see it, and even if you have the unique tags, right? It's not going to stick around for long, because no LP is going to pay for the returns of the fund out of their own pocket. That's the reality of the situation. So, but if you have a genuine view on market direction, regardless of asset class, because right now we're kind of talking just FX, but this goes across multi-asset, then you'll find a home. You'll find a good LP that'll customize the liquidity that you're looking for. But if you're just looking to pick people off and run a multi-venue ARB strategy, your time is going to be numbered, and pretty soon you're going to be homeless. No matter what, no matter who, no matter what they say in the sales pitch, it's just not sustainable.
I actually totally agree with Mohammed there, because, yeah, like what I do is not like a pure latency ARB. Like, it's not like I'm not trading on a dead price. And those clients you're better off just not catering to them, to be honest, because, yeah, those are just picking off a dead price. We're more of I mean, it goes in the right direction, and it goes in the right direction quick, but it's not like a pure, like, latency ARB play, and those are kind of dangerous.
I think the most efficient place to transact high-frequency aggressive trading is ECNs, where you have real bids and offers, real interest that people are putting into the market, where they actually want to be hit. Someone's putting a bid into Hotspot or EBS or Reuters, etc., because they have an interest to buy. And if a high-frequency trader wants to sell at that price and they get matched, everyone's happy.
Yeah, but again, those are genuine people with a view on the market, right? Even if their time horizon is short. But if you see this all day long, right? You can customize liquidity. You can see the unique tag. You can be in an ECN. But you made the point before. I mean, you'll damage the liquidity even inside the ECN, right? So I think the moral of the story on high frequency is, if you have a view, great. There's a lot of people that can facilitate that. If you don't really have a view, then you need to figure out how to get one, because you don't have a long life in the space, regardless of what part of the food chain you're interacting with.
Yep. Cristian, from a technical perspective as well, on the same question, high frequency, what's your view on that?
From a technical point of view, I agree with Ryan. I think the positive is that, these guys have really pushed the boundaries of the system. In order to be able to cater for their needs, you need to be able to offer completely unthrottled feeds, very high frequency of rates, being able to process spikes in number of trades and so on. So if I'm to focus on the positive, this is what I would like to say. From the other side, I guess, yeah, the technology needs to be able to identify the flow, really, through tagging and other means. And then I guess it's up to the liquidity providers to know how to deal with it.
Okay, so tailoring liquidity, you have some solutions. That's basically the story behind tailoring the liquidity for you guys. Okay, I'm going to move on to the crypto space. Do you guys provide cryptocurrencies? Are the LPs set up to be able to do that? Is the market ready for it? Is there a market-making scene from your perspective in cryptocurrencies?
I'll take that to start, I guess. TradeTech Group, right now, yeah, we take on cryptocurrency risk. It's a unique price. It's our price. It's not recycled. It's an interesting topic right now, right? If you go down the floor, everyone's got their magic sauce. But it is still very early on in the cycle, right? As a market maker, there's not a lot of actual underlying venues that you can mitigate risk in right now. It's super capital intensive when you actually go out. There's a huge funding gap, right? There's a lot of redistributors of very small capitalized LPs, right? Which gives you a ton of counterparty risk. What we're trying to really do at TradeTech Group is to be a large capitalized, unique price in that crypto risk. But we are very clear with people from the beginning that if all you want to do is hit me for cryptos, like I'm not probably the best spot. But if you really want to have a relationship around a variety of things, we'll facilitate the crypto needs that you have and provide you a good price and a quality execution
So
experience.
you're cautious. And of course, that's because perhaps the banks are not there to back it up.
Well, it's not so much the banks, to be honest, because, you know, this is a lot, the cryptos are a lot like single stocks, to be honest. It's not at all really like FX. It's not really like an index. It really exhibits the traits more of a single stock with how the price moves. Let's face it, everyone wants to be long cryptos right now, like most of the consumers, right? Do you get two-way order flow? Yes. But whether it's TradeTech Group or other people on this panel or other retail brokers out in the space, most of us end up short cryptos on a daily basis, right?
Yeah.
And there's no derivatives in on any of the exchanges. Not a lot of the non-banks are pricing. You know, we're one of the few that do, but you have to be careful. And I think brokers in general also have to be really careful right now who they're facing, because there's a lot of things that sound great, but the reality of it is that this market is still probably a year or two of really being ready for prime time, where it looks like a DAX, it looks like a Euro, it looks like, you know, more traditional product. I think that's the reality of the situation. What we're trying to do is bridge the gap in the interim for
Ryan,
brokers.
before we get to you, Ryan, Ozgun, you guys don't do
Very quickly,
cryptos.
yes, so we're watching this market closely, obviously. UBS is very heavily involved in blockchain. But I agree we still think that it's an immature market for banks to be involved in, and we're not going to be offering any crypto solutions for the time being. Yeah.
Fine.
Yeah, so we launched crypto trading in just a few months ago in July. We took a very conservative approach. We even announced actually who we are partnering with. So we were in this product we completely don't understand. We didn't understand it. It's almost like the beginning days of margin Forex trading, if you recall. But, you know, where there was brokers all over the place. They were not regulated. They were providing. I remember 8 pip euro dollar spreads. It was
with
great,
commissions.
it was a great time to make money, and it seems like a new generation of this. But instead of the business more or less dictating the product, I have, you know, any new products that go on our platform, I go to our IT people. They are the experts. They know exactly what this product is about. But you know, we took a very conservative approach on this. We did a partnership with Bitstamp. All the trades are auto-hedged with them. I think the advantage of trading this product with us is that you face a regulated Swiss bank instead of an exchange. You know, but we're going to involve this service a lot more this coming year. But we're excited about it. It's making decent revenues for us.
Alex?
I think we took a really pretty hard pivot, not 90 degrees, but maybe like 75 or something after the Cyprus Expo after May. And we really made it our focus. I don't know if you see me on Forex Magnets. I've been starting to put up a bunch of content about articles about cryptos. And we really started helping brokers get set up with crypto liquidity providers. This is maybe a little bit more retail level than like UBS, obviously. But like we send it to either guys, so an example of like someone like an Alpha, or there's other FCA regulated brokers that provide liquidity, and then they either do it as a like a market maker, like a prop shop that will offer it like a CFD, a leverage CFD, or they'll do it as an STP scenario. And I definitely you got to be definitely way more patient with your LPs in this because it's new and things are going to come up and the volatility is there. So I agree with you guys that you got to be totally, it's there. There's LPs, but giving it a little bit more patience certainly helps. But I think also like you almost, if you're a broker, you want to add this to your offering for sure because clients are looking. I was saying on the crypto panel, like we went to the old school, if you guys remember, the Traders Expo, and we haven't gone in forever. And this is a whole bunch selling like info products, like in Las Vegas, like selling info products. They used to sell them on FX, like signals, when the green light flashes.
Red light, green light.
Yeah, exactly. And, I haven't been in the space. My friend invited me down. She was putting on an event there. And we're like, are people going to be talking about cryptos? And that's all they're talking about. And the launches, they used to do these product launches for these info products. they were FX, and I'm sure you guys remember maybe like Fab Turbo, Forex Made Easy, all those things. Well, now anything with like cryptos, like Crypto Made Easy is coming out for sure. Like it's gonna be there. And you guys were talking about long buys. There's definitely, I agree, there's a long bias. But from what we've seen, we made a ton of content. So these guys are getting retail leads. You know, they're doing $10, $15 million launches as opposed to 2 or 3 that they were doing for Forex. So they're getting a ton of leads. And they're definitely both short and long. So you're going to start seeing that stuff. You're also going to see it, I was saying on the last panel, like people that are doing mining, their biggest risk is the underlying what they're mining going down. So they're going to need to hedge. They're going to want to do short. And, you know, products like indexes are coming out. You know, Mohammed mentioned it's like a stock. Well, crypto indexes are like, you know, we're working on some projects with that as well, which takes away basically, you know, I think it's alpha risk.
Okay.
So,
Peter?
it's in place.
Yeah, so it's a very immature market. It's new. The clearing isn't really established. So again, as Ozgun said, a lot of banks aren't willing to get involved. The clearing is a problem, but it moves around. It's volatile, and people trading and investing like to be able to take advantage of the volatility. So Saxo Bank has decided to offer clients access to derivative products. The ETN available on OMX and Stockholm, Nasdaq exchange. So clients can trade on that and have access to the movement in underlying Bitcoin. And also, obviously, everyone knows that CME will be bringing out their futures contracts at the end of the year, which I think it goes a long way to legitimizing the underlying product itself. But that will give clients a much more regulated way of actually having exposure to Bitcoin without the inherent problems of the custody and the clearing and the owning the actual product itself.
I think next year this time, this market is going to be light years ahead of where it's at right now as far as maturity. I think you're going to see fun things like you talk about the crypto indexes. You're going to see people denominating their accounts in cryptos, being able to trade derivatives, you know, instead of opening your account in euros or dollars or whatever, it's going to be Bitcoin or whatever. You're just going to see a ton of stuff, right?
So even like UBS and Divisa will offer Bitcoins.
You could
That's
do.
where we're going to be.
I can provide that service too if you'd like.
Yeah, you want
right?
to?
Both of you guys, right?
Thank you.
So
Thanks, but no
I just
thanks.
think it's a fun space right now. I think my message, you know, from TradeTech's perspective is you just have to be careful. Like you're talking about, like, you know, the Freedom Rocks, the Forex Made Easy, all that is like happening, right? And so
Yeah,
like
big time.
even at the show, like, you know, so lots of times when I talk to people that we provide liquidity to, I say, you know what? Remember this. If it sounds too good to be true, it probably is. So just be careful, right? Because the market is still immature. And, you know, can we provide liquidity? Absolutely, right? Will we make sure you got a good experience? Absolutely. But we're probably going to have some really interesting conversations along the way, right? So you just have to be
Cristian,
careful.
you must be seeing the most Bitcoin flow out of us, all of us.
No,
What are
not
you seeing?
really. Well, there are definitely plenty of solutions out there. As you know, we follow our client requirements, really. So we had to put in place quite a lot of integrations, really, for this, for different ranges of, you know, cryptocurrencies. But really, from a technical point of view, I don't think there's so many challenges, except maybe, I don't know, just trading over the weekend. I think that can be an issue. I actually wanted to raise this to see if anybody has looked into that and what are the solutions.
Yeah, I mean, we provide liquidity over the weekend. You're not going to see the same type of spread width over the weekend that you see during the week, obviously. I mean, full disclosure, right? But, I mean, you can get the liquidity over the weekend, but it's evolving. I think that the key thing with cryptos is it's evolving. And I think everyone here that's here for the liquidity panel, just be careful wherever you go.
So Cristian, do you guys see a lot of Bitcoin flow? Have you measured it? Is it as big as certain currency pairs?
No, definitely not. I think it's still at the very beginning at the moment.
Not much flow.
Not that much. I think it's important for brokers and liquidity providers to offer it. I think it's very hype right now, but
The flows are not there.
The flows are not there as you would expect given the volatility. That's at least what we have seen via our systems.
But then again, you might not be the biggest
Probably
in
not.
that space.
You know, you almost have to look back at the end client. You know, it's kind of a theme with before. What does the really retail end client want? You know, and when we went to this event, in Vegas, the Traders Expo, the marketers that are pushing the elites through, they didn't even know that there was a CFD product. So we were lucky enough to like, oh, by the way, you could do this. It was like, so I think you're going to start seeing, because they're doing these launches, and the retail, the end, you know, the $3,000 accounts, they want it. Like anything with the word crypto, they want. So, and that all carries all the way up the chain. So you gotta cater them. I mean, it's like we're seeing it. It's like Forex in 2003 on steroids in slow motion. It's happening.
What about the leverage?
Well, I mean, certain LPs, I mean, they can go as high as like 20 to 1 on cryptos. I mean, even 50 to 1 in some cases. So yeah, so they can offer that. They got a lot of money behind it, and they're making, you know, they're acting as a market makers. With exchanges, it's a bit different, obviously, because those are all one-to-one. Some exchanges have some borrowing system where they could do it like 3 to 1. Yeah.
Okay.
Like STPC.
Cryptos are volatile. Speaking of volatility, how would both clients, brokers, LPs protect themselves against the huge volatility that we see every few years? SMB, flash crash, Brexit crash. What do you guys provide to help clients, and how do you protect yourselves in this kind of scenario? Peter?
Responsible leverage, I think, is the answer to that. You know, I mean, I don't know how much Bitcoin increased last weekend. The Bitcoin Cash, was it like 1,700% or something?
Something like that.
I mean, if you're offering 10 times leverage on something that moves 1,700% over a weekend, you know, it's a disaster waiting to happen, isn't it?
Cristian, so what do you guys provide that lets people like us protect ourselves from analytics?
Well, I think mainly like Peter mentioned, it's really about having conservative approach to things. From a technology point of view, there are certain things that you can do really and have the infrastructure to deal with. Analytics, I'm not so sure how much they can help in such black swan events.
Fast tools, faster servers than the others. What is there that you guys can provide?
Certainly having a very stable system and with huge capacity can help at the very beginning of such an event. But really, I don't know what you can do if the prices are pulled. So it's really down to being the first one to get out, I think, of the positions. And after that, I don't know.
Ozgun?
I can only comment on SMB and flash crashes, and I can't comment on Bitcoin or cryptocurrency, obviously. So firstly, I think we need to differentiate SMB and flash crashes. You know, SMB was a macroeconomic event. And in macroeconomic events, that drastic, you know, events, the market moves quite a lot, and it kind of, you know, goes to a level from where it was before, right? Whereas with flash crashes, they tend to have a mean reversion. You know, in a short space of time, the market tends to go back to its original, more or less original levels. So how do you protect yourself from something like this? As a liquidity provider, we price thousands of clients, and we have automated fail-safe systems that kick in, you know, in these kind of situations. We also have a traditional voice trading desk that would step in if required to execute orders. I mean, it's quite essential because an element of judgment is generally required in these difficult conditions, and a human trader is the only one who can have that judgment, right? Having said that, we continue pricing electronically in these difficult market conditions according to the market conditions themselves, and we accumulate quite large risk positions as a result. One thing we noted, especially after the SMB, you know, because I don't think we were seeing that many flash crashes before SMB. I you know, correct me if I'm wrong, but I think that we're seeing more flash crashes after SMB. So one thing we noted is that the risk appetite of liquidity providers have shifted in our space. To give you an example, we try to make a two-way price in all kinds of market conditions. We priced in the sterling flash crash. We priced more recently in the Turkish lira as well. But I wonder, if all liquidity providers didn't pull out and continued pricing, would we even have the flash crash in the first place?
Yeah, I mean, that's a good question, right? I agree with you in some ways and disagree with you in others. I think one of your main points is about people and expertise and pricing through chaos, right? And during volatility.
Correct, yes.
I would disagree that the flash crashes are more prevalent now than later. I think the first flash crash that I was a part of was in 1997. It was in Swiss and dollar mark when 3 central banks intervened between the close of the IMM and the open of the IMM. And then you had, 9/11. You had the real estate crash based off of CDSs. You had tsunamis in Japan. You had SMB. I think, for us, our market making organization has been through all of those things. And, for example, my market making organization was at Gain Capital. Now we're at TradeTech Group. But during that time on SMB, that was one of our most profitable days in probably the last 3 years, as a company. But it's about people. It's about leverage. We do a lot with volatility products to try to predict what may or may not be happening in the underlying markets. So it's about, again, your expertise. For example, with SNB, Gain was one of the first that started to move on leverage because our market-making volatility desk spotted some inconsistencies, and we started to pull back leverage, right? That's the same way that we operate now at TradeTech Group because it's the same market-making organization, right? So volatility is a good thing, but it's also a scary thing. So again, it's about your LP. Are they just aggregating, or do they actually have a unique price? Because if they do both, which is what we do, then you're going to be good in all conditions. If it's just about the combination of other market-making liquidity, you're going to be susceptible to no bids or offers, right? But again, everyone's a little bit different. I think it's a combination of a lot of things on how you protect against volatility.
Right. Being good in all conditions.
Yes. The best way, or the best way for brokers to mitigate the risks of a flash crash, whether it's an SMB or the sterling flash crash or the Turkish lira we had a couple weeks ago. First off, before the SMB, many brokers were using one liquidity provider. I think since the SMB came out, people started diversifying the liquidity providers. They started not only looking at single bank APIs, but they started looking at ECNs, even central limit order books, things like this. So that's more or less covering helping mitigate the market risks. But the next thing is the credit risks. So stress testing is quite important to do. So what I recommend, what we do is we stress test against various gap risks. So it's very important to know where your exposures are on your clients on an instrument level overall, and play out various scenarios of gap risks. And then, and be proactive, like Peter said, be proactive on adjusting margins, when necessary, when these gap risks get a little too uncomfortable for you.
Also, the consequences of after a flash crash. When the official market low could be there, but actually, because you've traded with a particular LP, you could have traded there. And having decent relationships with LPs and having some buying power with them means that you can go back and everyone, hopefully, reprices the trades to within the market norm so that people aren't disadvantaged. And actually having a decent amount of business that goes to LPs rather than underlying clients being individual, going through, say, a prime broker or a larger LP means that you have that ability to get a fair price and try and correct some of the problem caused by the flash crash.
Alex, flash crashes. Have you caused any?
Yeah. Not in Forex, other things in life. No, I mean, this is definitely more for these guys than me. I mean, I think it's a question of leverage and deposit and net open position, things like that. I mean,
okay,
that's
and also going back to the Swiss National Bank particular example, the creditworthiness of your counterpart is obviously very important as well, because that dislocation of the market obviously caused a lot of firms to go to the wall. So making sure that you're placing your money with a well-capitalized institutions are very important when the market moves in a crazy manner.
I think that's one thing, all these topics that we're talking about, like when you're a broker and you're choosing your LP, you have to really be concerned about the balance sheet of your counterparty, how they're pricing, what they're providing. But really, at the end of the day, during volatility, which you never know when's going to happen, are they going to be there the next day, right? If they're just running a huge portfolio and they have a relatively small balance sheet, well, they might have got that wrong, right? And then what are you going to do? So you have to be with, someone that is, I hate to say it, but it is bigger. And they have to at least be one of your options, if not your main options. Like, you can complement it with maybe niche providers of certain products, but I think you really have to make sure that you tick the regulatory box, the balance sheet box, and just the overall quality of execution. That's really what you're most concerned about when you're selecting an LP.
Okay, Cristian, anything to add on this?
No, I think these guys covered it
Okay,
well.
so can we move on quickly to regulation? How that can impact liquidity, how it can make people move out of certain markets, move in, last look, regulation, perhaps even the word mifid too. So
let's not go there.
yeah.
Look, our view is competition and regulation makes the market more transparent, and we shouldn't be scared of it. We should just embrace it, adapt our businesses, and move on with it. So I don't see that there's going to be any issues with liquidity with more regulation.
Feels good to hear that.
I'm a big proponent of regulating markets. I'm a big adversary of over-regulating markets, right? I think regulation of market brings legitimacy. I think, though, as an industry, we have to be careful, in how we act, right? I think, for example, not to get booed in the room here, but I think if we wouldn't have had this onslaught of binaries in the market over the last 3 to 4 years, that we would not be in some of the situations that we're in now, right? Regulators don't like fraud. I think it's upon all of us in the industry to do business the right way, right? And then I don't think we have to worry about regulation. I think when you take advantage of moms and pops, you're asking for trouble, and the industry will pay the price.
Yeah. Ryan, Swiss regulator, bothering you guys?
It's always challenging, but we're able to manage through it. So, but the point I can say on this is that regulation is going to further increase costs. Capital requirements become greater, and this is going to cause smaller companies to really struggle during these times. So I think competition will get less in this space through, as these regulations come forth, and we'll see how it evolves. But I think there'll be less competition in this space.
Peter?
In FX broker world, I think one of the biggest changes in regulation has been the lowering of leverage that we've seen, maximum leverage numbers from certain regulators around the world, and I think that will continue. I think firms that compete purely on leverage will lose their USP on that, and other services offered by LPs, banks, prime brokers, etc., which aren't related to leverage, such as service, technology, quality of pricing, etc., will be more important in people's minds.
You guys, anything to add here? We're running out of time anyway.
Not really. No, it's fine.
Okay, Jonathan, do we have time for a question from the crowd? Any questions?
We answered all their questions.
I think we did. Okay, that's it, I guess. Jonathan, right?
Thank you. Thank you very
me.
much.
Excuse me.
A round of applause for the distinguished panel. We have a question. Wait a minute. 1 minute, last minute surprise. Yes, please.
Hello to all speakers. I would like to ask, how do you see the future pertaining to regulation of liquidity providers in terms of cryptocurrencies in general?
A quick one.
It's coming. The regulation's coming.
I think that ultimately the cryptos, particularly if they're structured as a derivative as opposed to the underlying cash product, will be regulated in the same way. I think that when the regulators see something new, they did this with FX, they try to fit it into a bucket that they understand. And I think at the end of the day, the cryptos are numbers moving up and down based off of supply and demand. The regulators will look at that and they'll try to regulate it in the same fashion if it's structured as a derivative. I think if it's the actual cash product traded on an organized board of trade like a crypto exchange, I think that's a bit different. But I think if you're wanting to trade it on leverage, two-way in the market, it's structured as a derivative, it'll be treated as a derivative, whether that's a CFD or an option or whatever.
Ryan?
I don't really have comments about this, but Switzerland regulates crypto. We were the first bank who got approval to offer this as a product to the public. There's still a lot of things, characteristics about the cryptocurrencies which still need to be considered in from the regulatory perspective. So we'll see how it evolves. I expect more regulation in this space.
One interesting thing to add is that the CME, the Chicago Mercantile Exchange, is coming out. They're saying December. It's probably going to be more like beginning of, when it's going to be really heavy to beginning of next year. But they're coming out with a futures contract for Bitcoin, and that's a big hype among like futures IBs and futures firms. So that's going to be a truly regulated, structured product on an exchange.
And being based in the U.S., the CFTC has made it clear that the cryptos will be regulated as such, as a futures contract or an OTC derivative.
Great, thank you all.